Hello, my name is Clive Thompson. You probably can't guess where I am from the scene behind me, but I'll give you a clue. It's a country of great philosophers historically, and also many other famous people. I'll give you more clues in a minute. But today we're going to be talking about exchange traded funds, ETFs as they are known. So just before we jump in, let me give you some the famous people from this country and see how quickly you can spot the country. Of course, it's the home of Alexander the Great. That's the man who was told he'd become a great ruler if he could undo the Gordian knot, and he cut it through with a sword. And there's some other famous people from this country, including Socrates, Plato, Aristotle, who was all of them were philosophers, and Aristotle was a scientist as well. We had Homer, who wrote the Iliad and Odyssey. Obviously Pythagoras, who wrote the Pythagoras' theorem, or discovered the Pythagoras theorem. You know, the square of the hypotenuse is equal to the sum of the square of the other two sides. Then there was Hippocrates, who was the father of modern medicine. He basically discovered that illnesses are caused by natural causes and not by evil spirits, as people had previously thought. Then, of course, we had Archimedes, who was famous for what's known as the Archimedes principle. Basically, the story about Archimedes was he was asked by the king to discover if the crown, which had been made by a goldsmith, was made of pure gold or not. And he was sitting in his bath, and he suddenly realized that the level of the bath water about displaced depending on the size of the body which was put into it. And he leapt out of the bath and ran down the street shouting Eureka. It's not recorded whether he's naked or not, we don't know that, but he ran down the street shouting Eureka, which means I found it. But basically he discovered that if you put an object in water, the amount of water it displaces and the extra weight, if you use that information, you can determine the density of the object and therefore determine if it's real gold. Unfortunately for the goldsmith concerned, the crown turned out not to be pure gold, and given the period when this happened, I imagine the goldsmith didn't come to a very happy ending. Who else do we have? We had Nana Mouskouri, the great singer. But let's go on. You've probably discovered the country by now. It's Greece. So let's go to exchange traded funds. The most common form of exchange traded fund is a fund which tracks equity prices. So one of the best known exchange traded funds has the symbol SPY, or nicknamed Spider, because it tracks the S&P 500. So the SPY owns all 500 stocks in the S&P 500 index, and it owns each stock proportional to its market capitalization. So the largest stocks, that's companies like Microsoft, Nvidia, Apple, Amazon, Tesla, those sort of companies, otherwise known as the Mag 7, those companies are the largest companies in the S&P 500, and they form the bulk of they're the largest holdings in the ETF as well. So those 7 stocks, known as the Mag 7, probably account for 35% of the value of the SPY, which tracks the S&P 500. But you've still got 493 other stocks in the fund. So then of course you've got ETFs which track other well-known indices, such as the FTSE 100 in the UK. An ETF which tracks that will have 100 stocks in it. Then you'll have one which tracks the CAC 40, the CAC 40 index in France, which has got 40 stocks in it. And there'll be there'll be ETFs, exchange traded funds, tracking the German index, the DAX index, the Hang Seng index, and basically any index that you can think of, including there is an ETF tracking the World Equity Index too. So if you buy one of these exchange traded funds, you're going to end up with one investment which internally owns all the shares in a particular index. So What's the advantage of buying an equity-based exchange-traded fund? Well, the first advantage is that you're getting a large number of stocks inside one investment for only one brokerage fee. So instead of, if you're interested in the S&P 500, you don't have to buy all 500 shares or the Mag 7. You just buy the ETF, and instantly inside the ETF you will own effectively all 500 stocks in the S&P 500. Likewise, if you were to buy an ETF which tracks the FTSE 100 index through one single investment, and that's only one brokerage fee, you're going to own the equivalent of all 100 stocks in the FTSE 100. So it's a nice, easy way to get exposure to a broad range of different equity investments and not pay multiple brokerage fees. Another advantage of an exchange-traded fund compared with, say, mutual funds, unit trusts or investment companies is the very low total expense ratio. The total expense ratio, or TER as it's sometimes known, is the ratio that has to be paid, or the fee which has to be paid to the investment managers. Now, if you have a professionally managed fund, such as a unit trust or a mutual fund, there will be some very high fees inside that, because the managers who are picking stocks inside the mutual fund are very skilled people and they earn very high salaries. So compared with a mutual fund or a unit trust, an ETF doesn't need highly skilled people, because there's no skill in picking all 500 stocks. A computer can do that, and that's exactly how they work in general. Basically, it's computers which put the stocks into the portfolio, and you don't have to worry about whether the manager is a skilled manager or not a skilled manager. You're going to earn all 500. Another advantage, and that is to do with the skill of the managers. We have seen historically that the vast majority of investment managers who are running mutual funds or investment trusts or unit trusts, the vast majority of them, their funds tend to underperform the relative index, and the longer the period goes on, the more they underperform. So realistically speaking, there'll be very few who, in a long, over 5 years or 10 years, very few who actually turn out to outperform the index which they're aiming to beat. And even if they've beaten it in the past, there's no guarantee that they're going to beat it in the future. So an ETF doesn't have that problem of, is the manager good or bad or useless? The ETF basically owns all the shares in the index. They're chosen by computer, not chosen, they're just basically put in the index by the computer because they simply exist in the index. And that's why the fees are so much lower than a mutual fund. And in most cases, the performance turns out to be better than a mutual fund. But that's not a guarantee, of course. So those are equity exchange-traded funds. But exchange-traded funds exist for other types of investments too. So they exist for bonds. We have bond ETF, or maybe they're called fixed income ETFs, have currency ETFs, commodity ETFs, and there's a number of specialized ETFs as well. So if you look on the internet under Google, you can look up exchange traded funds, or just put in the symbol or the word ETF, and you will find literally hundreds, probably thousands of exchange traded funds to choose from. And depending on what you like, you can choose what you like. So if you like technology, you'll find for sure some technology-based ETFs. If you like high dividends, you'll find some dividend ETFs. For example, one which is quite popular is called the Dividend Aristocrats ETF. That particular exchange-traded fund only invests in companies which have always increased their dividends for the past 20 years. So 20 years of increasing the dividend without interruption qualifies it as a potential investment for the Dividend Aristocrats ETF. But they go one step further. Having taken all those companies, they then sort them according to the dividend yield and only put into the index or into the ETF the top 20 or the top 50. They only put in the top highest yielders of those companies which have always increased their dividends. And the advantage that you've got there is an expectation that the dividend you're going to get will continue to increase over time because the companies which are in the index have got a track record of always increasing their dividends. So that's an example of a specialized ETF which focuses on a special type of strategy. But likewise, there are sector-based ETFs. For example, there would be exchange-traded funds which invest in commodity companies which are mining companies. They'd be called natural resources, probably, exchange-traded funds. You'll find exchange-traded funds exposed to the pharmaceutical or medical sector. Again, if you have a view that we're going to require more medicines over time and more drugs as we get older, and as the population ages, maybe that's a good bet. There's also funds exposed to other types of investments. Give you an example, real estate as an example. Then of course there's even an ETF which more or less tracks the Mag 7, and another type of ETF we'll find, I don't like them but they're out there, are ETFs which track just a single stock. I can't see the point of buying an ETF to track a single stock when you could have bought the stock itself, but yep, they exist too. And let's talk about a special type of ETF which I don't like, but you need to know it's there. It's called the leverage ETF. These are ETFs which give you double the upside or double the downside of a particular index. So if you think the Nasdaq 100 is a great index and you think it's going to go up forever or go up a lot, you could buy an ETF which is a double or triple performance. They're called 2x or 3x ETFs on the upside. And if the Nasdaq goes up by 1% in a day, on that day you can expect to make 3%. But there's a major disadvantage with these ETFs. Because of the way it works, you also lose, if the market goes down 1% on the day, you'll lose 3% on a 3x ETF. You'll lose 3x on the way down too, so you're 3%. But the trouble with going down 3% is to get back to 100, get back to the starting point, you need a rise of more than 3%. So the reality is that all these leveraged ETFs will, even if the index goes up and down, up and down, up and down for a long time and ends up where it started, you're almost certainly going to end up with less money than you started with because of the way it fails to track the underlying index in the long run. So if you read the small print of these leveraged ETFs, they all point this out and they all recommend that your holding period be very short, i.e. less than a day. But there's plenty of people who buy these things and hold them onto them for the long run. And going with the leveraged ETFs, let's just talk about the inverse ETFs. And there are, of course, inverse leveraged ETFs which do 3x too. So what's an inverse ETF? An inverse ETF is an ETF which is designed to perform in the opposite direction of the stock. So basically, they'll have a short position on the stock. So if the stock goes down, you'll make money, and if the stock goes up, you'll lose money. So that's an inverse ETF, and the equivalent would be, or the other version would be the leveraged versions of that. But the same principle applies. Over time, you're likely to lose money if you hold it for any long term, because the sum of the ups and downs don't balance out to zero. Another type of ETF which is out there is called the actively managed ETF. A good example of that is ARK, which is run by Cathie Wood. That's a technology-based ETF, and the stocks are directly picked by their team, and the ETF basically tracks those stocks from their stock list. You could say it's good or bad, but it does have some of the advantages of the ETF. You can buy and sell quickly, and of course you've got very low fees inside, a little bit higher in that case. And the last type of ETF I'd like to talk about are some of the specialist ETFs. I won't go to all the specialist ETFs which exist, but I'll talk about one particular type which is becoming more popular. I'm going to say for most people listening to this, I don't like it, but it would be great for certain people and great for pension funds. Potentially, not definitely. These are the ETFs which specialize in holding a stock or an index, and they sell options against that stock or index, and they distribute those option premiums as a yield. So in those sort of ETFs, you can get yields of anything from 10% plus to all the way more than 100% plus, which sounds great, because you might think, well, if I'm earning 100% a year in dividends, how can I lose money? Well, the problem with the ETFs which sell options against an underlying index or an underlying stock is that when the stock goes down, you participate more or less in full on the way down, and if the stock goes up beyond a certain point, because they've written call options, you'll only get a very tiny fraction of the upside. So once again, in a volatile market, you're going to find that although you've got this high yield, your share price is going backwards. Now, when you add up the amount you've received in terms of dividends over a year and the decline in the share price, you might find that you've got enough in dividends to compensate you for the decline in the share price. Probably you have, but if you're a taxpayer, that's probably not true, because if you're a high rate taxpayer or a medium rate taxpayer, all of those dividends are going to be taxed on you. Maybe not in every country, but I would think in general you're going to be taxed on them, and therefore your return after tax is much less. So what's the point of earning, let's say, 30% in dividends minus 50% tax? That's a high tax rate, by the way. I'm sure it's less in many countries, but you earn 50 minus 50% tax, so you only earn 25, and the stock's gone down 30. So you're actually negative 30. Now that decline of 30% of the stock price is not the stock which has gone down, it's the ETF which has gone down because of the way it works, capping the upside, but no limit to the downside on each price change. So you would have, after tax, have lost money. But if you're a low taxpayer or a non-taxpayer, such as a pension fund, for example, or some kind of trust which is not subject to tax in some way, then that's a great idea, because, well, I'm not going to say it's a great idea, but it's an idea to be looked at, because you can earn a very high income and a very high cash flow, obviously, albeit still understanding that the value of the price of the ETF is likely, and it's almost dead cert, to go down. And I've looked at all of these that I've found, and every single one of them has gone down despite a rising stock market. There might be some out there which haven't, but the ones I've looked at have all gone down. So it's an interesting idea if you need a lot of cash flow, and also if you're not much of a taxpayer, you don't have to pay taxes for some reason. But for most people who do pay taxes, it's not a very good deal. Anyway, that's about all I've got to say on exchange traded funds. If you have any questions, don't hesitate to drop a note to me. How do you find exchange traded funds? Just go into Google, type ETF or exchange traded funds, and you'll find several sites which specialize in looking at everything which is available in the ETF arena, and then you can scroll through it looking for the one you like. Should you have a portfolio? Perhaps let's just discuss, should you have a portfolio of ETFs or direct stocks? Well, I'm not a great fan of ETFs. I think they're great for lots of people who haven't got the time to study stocks. But personally, I like the idea of being able to pick my own stocks. Because if you think about it, if we take the S&P 500, there's 500 stocks in that index, and you'll get the average performance of the S&P 500, the middle of the road performance. But don't forget, for the average performance, 250 of those stocks will have performed better than the average, and 250 will have performed worse than the average. So what would you rather have? The better half of the 250 or the worse half of the 250? Well, my personal view is I'd like to buy the better half of the 250. Now, can I do that? Probably not, but at least I can have a go. And I've got a reasonable chance, even if I pick 251 good ones and don't buy. Let's say I pick 250 stocks. I beg your pardon, hoping to get the 250 best ones. But out of that, 250, 120 of them turn out to be in the worst sector. Well, that means that 130 are in the better performance. So, net, if I pick my own stocks and I've been even slightly good in it, in theory, I should be able to outperform the S&P 500. Reality, most investment managers fail to do so. Those of you who have followed my Beat the Benchmark for portfolios published on LinkedIn at the start of 2024 and the start of 2025 will see that I've successfully beaten the benchmark and really big time. But we can't say that's going to happen every year. But I have to say it's a lot more fun to try and beat the benchmark than just doing what the benchmark does by buying an ETF. But if I was lazy, if I had no time on my hands, if I didn't understand things, buying the ETF is a great idea. If you've got a lot of time on your hands and you enjoy doing research, I think it's a lot more fun to buy the individual stocks. So like, subscribe, and there'll be many more lessons on investing in stock markets. I've been investing money for 50 odd years. I've made a lot of mistakes. I hope that you'll learn from some of my mistakes and not make them. And I've tried to follow many of the greatest investors in the world. And I'll tell you what I think works and what doesn't work in some of my future videos. So if you subscribe, you'll get notified. If you hit, at least if you hit the little bell, you'll get notified when one of my videos is published again. Thanks very much to everybody, and also I'd like to thank those of you who sent such nice comments on my previous videos. They were really appreciated, and it's your kind comments which encourage me to continue sharing my knowledge and sharing my information with you all free of charge. I don't have any newsletters, I don't have any subscription services, I never ask for an email address, I never ask any logins, and if you see someone pretending to be me or looking like me in the comments section, it's not me. If they are proposing that you move and communicate by WhatsApp, I don't use WhatsApp or Telegram or anything like that. You can find me on LinkedIn. That's the only place you can find me. So if you want to write me a message, you can write on LinkedIn. Or of course, if you write a comment below underneath this video, I will, at least for the next 7 days, try to monitor the comments and reply to you. So thanks very much indeed, everybody. Like, comment and subscribe. Bye for now.